So did the Fed just raise rates on the entire country under the wrong premise and the wrong data? It is possible. According to the Federal Reserve Bank of Philadelphia, they just came out with a contradicting report that may tell us some more information. We're going to call this report the Early Benchmark Report. And reading it, it does have some interesting information. I'm just going to read a little blurb from it. Estimates by the Federal Reserve Bank of Philadelphia indicate that the employment changes from March through June 2022 were significantly different in the 33 states and the District of Columbia compared to the current state estimates from the Bureau of Labor Statistics. The current employment statistics early benchmarks indicate higher changes in 4 states, lowering changes in 29 states, and the District of Columbia with lesser changes in the remaining 17 states. So that's a mouthful, but let's look at the chart here. So the chart shows 2 different lines that are different from their report. Their report is in blue, and the 2 lines are gray and yellow. And the gray and yellow indicate changes of 3% and 2.8%, while the line in blue is 0%. Now, why is that the case? So the line in blue is showing what the report found, while the other 2 lines are from the other Labor Statistics reports. And the report found 0% change, while the other 2 found an increase of 3% and 2.8%. Now, reading the report says, in the aggregate, 10,500 new net jobs were added during the period rather than 1.1 million jobs estimated by the sum of the states, which is the report that was previously used and could be used by the Fed to determine rates. So they say reports that they might have used show a 3% growth and a 2.8% growth. So that is quite significant considering that the early benchmark report shows 0% growth with a 10,000 jobs added basically. So the Fed is looking at 3 different things in order to determine if they should be increasing rates or not. They're looking at good prices, which include fuel, food, different things that are going to be used every day. They're also looking at housing prices, and housing prices have started to come down. Rents are pretty much the same, but forecasting into 2023, we should be seeing housing prices come down. Now, the third thing is employment. They need employment to stay down. So they're looking for a decrease in employment, or at least a neutral barrier going forward. And this report is showing 1.1 million and 10,000 jobs created on the other one. So why is there such a big difference between these 2 reports that are in theory supposed to be measuring the same thing? Well, if you think about when the 1.1 million report came out, that was right before the election terms. Now, I'm not trying to say one way or the other, but in an upcoming election, it could be important to see a nice jobs growth. It's going to look nice for when people are going into the polling centers. So I'm not saying that's the reason, but a 1 million difference is pretty significant. But why is that a problem? If the numbers are being hyped up and the Fed is using these numbers in order to control policy, there's going to be a problem. If the Fed is seeing another million jobs created while they're actually looking for a reduction in jobs, that's a problem, and the Fed is going to do something in order to tame that employment number, or allegedly if it's even the right number. They chose a rate increase of 50 basis points in order to keep employment down, but if it's the wrong numbers, then let's see what Powell has to say.
At today's meeting, the committee raised the target range for the federal funds rate by a half percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
So the Fed is doing this in order to keep inflation at 2%. Like I said, that's the goal every year, is 2%. They're a little above, a little below, but they want to average 2% year over year. And this year it's going to be 5.4%. So we have to do something significant in order to bring that down by their goal of, I think, 2025, is they want to get back to the 2% goal. So according to the Bank of Chicago, so their goals being 5.4% for 2022, since it's already over, 2.8% for 2023, 2.3% for 2024, and 2% for 2025. Now, is that realistic? I don't think so. I think we're shooting a little hot there. But if we look into the inflation rates from 1990 to 2022, we can see that 2% is still going to be higher than we've been dealing with for the past almost 10 years, especially on an average. Let's go back to Powell.
We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. Restoring price stability is essential to set the stage for achieving maximum employment. And
so the Fed announces a 50 basis point increase, which he still sounds skeptical of what is yet to come, considering we're at 4.5% and the target rates for the federal fund rate seem to be between 5 and 5.25% over the next coming year. So good news being the 50 basis point increase is less than the past 4 consecutive 75 basis point increases, but this is still historically high, as we haven't seen numbers like this in the past 22 years. So weathering this storm could be a little bit different, and we saw that in the stock market with a significant sell-off this past week, in the past couple days actually. Fed is also engaging in quantitative tightening, which means the maturing bonds are just rolling off the balance sheet each month instead of reinvesting as we previously had. This means that $95 billion is allowed to come off each month, with a total of $332 billion being taken off the balance sheet so far. But the balance sheet still stands at $8.6 trillion. So we'll have to see what the Fed does in their next meeting, which I think is going to be at the beginning of February. It's slightly concerning what is happening, considering they might be forcing us into a recession, but if they're using the wrong data, could we see them retract or be more optimistic in the next meeting, considering, the data might be better than they think? I don't know.